Welcome back to this explainer. Today, we're diving straight into the crypto market as of May 8th, 2026. And honestly, the reality of what's actually driving the market right now, it is wildly disconnected from what you're probably seeing scrolling through your daily feed. We're officially moving out of that geopolitical war premium that totally dominated April, and we're stepping into a phase defined by massive structural shifts. To really get it, we need to look at the market like a giant iceberg. You know, there's the surface noise that absolutely everyone is talking about, and then there are these massive, deep currents moving quietly underneath. $5 trillion. That's a 5 with 12 zeros. That is the staggering size of the new sovereign wealth capital pool that is quietly stepping into the digital asset market today, establishing an entirely new baseline of scale. Seriously, if you're ignoring this just to trade the hourly chart, you're missing the single biggest shift of the year.
Okay, let's dive into this iceberg model. Here's what we're looking at today. 1, the surface friction. 2, the sovereign wealth pivot. 3, the sleeper headline. 4, the rise of agentic trading. And finally, the bottom line.
Starting right off with Section 1, the surface friction, those psychological overhangs and retail hooks. So, if you've been watching the charts lately, you know we've seen just immense daily volatility tied to all this shifting macro news. And a perfect example of this surface friction, 8.2 Bitcoin. The US government just transferred this exact amount, which is roughly $600,000, tied to the 2016 Bitfinex hack over to Coinbase Prime on Thursday. Now, objectively speaking, that's a tiny drop in a multi-trillion-dollar market, right? But these persistent state-level movements act as a massive psychological supply overhang. It spooks retail traders, and it creates the ceiling of fear that's currently preventing a clean breakout past technical resistance.
And you know, while that fear overhangs the market, we also have what I call the retail hooks. Following its really successful launch of SpaceX pre-IPO perpetuals, the BTC exchange has launched this massive retail marketing campaign featuring a literally huge Tesla Cyberbeast giveaway. During periods of price consolidation like we're in now, exchanges use these flashy tech-adjacent incentives to aggressively capture retail market share. Sure, it generates volume and gets headlines, but again, it is purely surface-level noise.
Let's move down the iceberg to Section 2, the sovereign wealth pivot, or the deep currents. While retail is out there sweating the daily news cycle, there are massive forces flowing beneath the surface. Fawzi Hamzeh of AAC recently reported that the Gulf Cooperation Council, the GCC, sovereign funds representing roughly $5 trillion remain highly liquid and completely undeterred by recent geopolitical tensions. They're looking at this market not in terms of days or even weeks, but decades. They're effectively absorbing the supply and just buying the dip created by all that retail fear.
It really is a tale of two markets. On one side, you have retail speculators. They're reactionary, driven by the dealing news cycle, trading the fear of those little Bitfinex hack movements. But on the other side, you have institutional giants with decadal horizons. The entry of this GCC wealth indicates that the next leg of this cycle is actually being built on a massive, non-reactive capital floor. It's structural accumulation that fundamentally changes the market's support levels.
Which brings us to Section 3, the sleeper headline, focusing on real-world utility.
So amidst all those sovereign wealth inflows, there was this absolutely crucial, underreported milestone today that you really need to know about. 4 million. Data now confirms that over 4 million merchants right here in the United States have officially integrated Bitcoin as a payment method. We actually spend so much time talking about institutional ETFs that we completely missed this massive victory for functional, everyday, real-world utility. And this expansion to 4 million merchants means Bitcoin is successfully decoupling. It's evolving from purely a speculative risk asset into a functional, stable payment rail. Why does this matter to you as an investor? Well, because this functional utility creates a network value proposition that is becoming structurally less dependent on Federal Reserve interest rate cycles. It's real-world bedrock. All right, Section 4, the rise of agentic trading. Further beneath the surface, the market is undergoing this quiet but huge technological revolution that is driving institutional scale at literal lightning speed. We are officially moving way past simple trading bots and into full agentic AI. Bitget has actually entered a strategic partnership with MuleRun to expand its agent hub ecosystem.
So now AI agents are analyzing complex data across spot and futures markets, utilizing integrations like the D-Bridge protocol for seamless automated cross-chain execution. And they're executing high-frequency strategies completely without human intervention. No humans involved at all.
And the ecosystem is actively preparing for this volume to hit. Binance US has officially launched TRX to USD and TRX to USDT trading pairs, which significantly deepens the liquidity for the TRON network in the US. And look, this is no coincidence. TRON recently integrated the D-Bridge MCP server to unify execution layers. Deepening this liquidity provides the exact scaling environment required for this new, automated, institutional AI infrastructure to really thrive. The market is just becoming smarter, faster, and far more efficient.
Bringing it all together, Section 5, the bottom line and where the market goes next.
So the crucial point is, we have surface fear clashing with sovereign capital floors, retail utility, and these crazy AI trading efficiencies. All of this has created a massive high-volume tug-of-war. The long-term accumulation from the Middle East is currently clashing with that supply friction, right at the $80,000 resistance mark. What you need to watch for today is the market turning $78,500 into a permanent structural support level. Because of the sheer efficiency of those new agentic trading algorithms we just talked about, if that $80,000 resistance is breached, we are looking at the potential for incredibly violent short squeezes, driving us toward an end-of-month target of $85,000.
And honestly, this is the ultimate takeaway for your strategy. We are all so conditioned to sit around and wait on the Federal Reserve. But if these GCC capital flows continue to accelerate alongside that 4 million merchant utility baseline, the market may finally break the Fed ceiling regardless of whether an official rate cut is ever announced. The deep currents are structurally overriding traditional macro rate cycles, plain and simple.
I really want to leave you with this final thought to consider. We've mapped the iceberg today. We see the $600,000 government transfers and the flashy car giveaways at the top. But if $5 trillion in highly liquid sovereign wealth is quietly accumulating on a decadal horizon at the bottom, why are you still trading the surface noise? Focus on the structure, focus on the utility, and follow the deep currents. Thanks so much for joining me on this explainer, and I will catch you in the next one.